Hello, I'm Robert and welcome to my channel, where I discuss everything automated algorithmic trading, or simply algo trading. We're going to pick up right where we left off with the last video discussing the Australian dollar US dollar trading approach using the channels indicator with the volume. We can already see on the chart on the screen that I show two positions where I've taken an open trade. Those two positions gave me an average. That average worked out to be a $4 profit. Now in this case, I took a profit when the candle went above the take profit. Slightly higher risk, but better profit. As we discussed in the last video, in terms of either you maximize your profit at more risk, or you minimize your risk at less profit. For this particular pair, I chose to take on slightly more risk at higher profit. But the problem with that risk is I need to diversify. I need to find a way to help offset that risk. So I need to find a pair that complements this particular asset that I'm trading right here. The best way to do that is to try to figure out what trades opposite of this pair. That is, when this pair is winning, my other trade should be theoretically losing. The perfect balance, or what we call in the trading world, inversely correlated. So let's go and see how that looks on the chart. But first, let's go up to Australian Canadian, and we're going to make a slight change to the chart. We're going to go to a line mode. And now from here, I want to add my comparison of Australian dollar. That is, I need to see how the pair I trade factors against the pair I want to trade. So, on the screen, you see this little plus sign right here? We're going to use this to add another pair to the chart. So we press it, and Australian dollar Canadian, it's the Australian US dollar on OANDA, and we're going to pick the same percent scale. We want to be able to compare the scales, and that's important. So we can see here something that's very important about this pair, and that is if we see the prices are closely aligned. Now we look back through the history of this pair a little more, and we can see how much this pair tends to follow prices between each other. The term used to describe this is called correlation. These two pairs, Australian US dollar and Australian Canadian, are correlated. That means they generally follow the same pattern. Now you will get situations like what we see on the screen where there is some slight differences. So this is a correlated pair that isn't perfect. Perhaps a 70-75% correlation. But these pairs, if you trade both of them at the same time, you're not going to be diversified. because they're both going to either profit at the same time or they're both going to lose at the same time. That is the problem with trading in just trading multiple assets. Multiple assets doesn't guarantee you diversification. You have to physically look at the entirety of the asset to determine how correlated or inversely correlated it is. For example, we can see on the screen right now that this particular section is inversely correlated. That is, they are opposite of each other. That's what we want on the large scale or the majority of the assets that we are trading against. We want two assets moving in opposite directions. When one gains value, the second one loses value, so they both balance each other out. Now, from the standpoint of the market, you are never going to find an asset that is 100% correlated. It's just not going to happen. But anywhere from a 75 to 95% correlation is a good enough approach to be able to balance yourself or hedge yourself in a way that gives you a good risk mitigation approach. So by using this technique of putting two pairs on one single chart, we can see how my strategy that I'm using on Australian dollar factors into Australian Canadian right now. And we can see the purchases and how well that actually plays out. So as we progress, let's see if we can find an asset that truly inversely correlates and complements the Australian US dollar. As we can see here, more of the same pattern. That is, more of the same correlation. Now this is Australian dollar, Swiss franc. Of course, Australian dollar, Japanese yen. Again, more of this patternistic situation. Australian New Zealand dollar. This is a bit of a strange one. There's not really much of a correlation, but at the same time, it's close enough that it might not be a good compatible match. This would be like a center ground, or what is often simply referred to as non-correlated. If we look at the chart, we can see just how unyielding this particular trend is between the Australian dollar, New Zealand dollar. There are some points of correlation. There are some points of inverse correlation. But overall, the New Zealand dollar is realistically just a flat currency. It doesn't trade well one way or the other as a good hedge against the Australian dollar. So with that being said, while it may be a good asset if you simply want a third level intermediate, it's not going to give you the hedging properties that you really should have in your trading. So moving onward, we can see more correlation. Correlation kills diversification. You have to be able to really look at that. And here you have an example of an asset that is very correlated against the Australian dollar. The Canadian Swiss franc combination is remarkably correlated. Same thing with the Canadian JPY. So you can really begin to see the connectivity of this process and just how well assets tend to work together. Now here we have a little bit of inverse correlation, but not enough. And that really is, for me, the concern that I want is I want more of an inverse correlation. But this does show the example of what I am referring to when you look at both of them in terms of how they swing completely opposite of each other. For example, you have up here versus down here in terms of the two assets. Then they cross over each other, and then you see that repeating where they tend to flow away from each other or diverge. So you have that clear example of exactly what we're looking for, but now we need to find the asset that takes this to a more dramatic approach to be truly diversified. More of an inverse correlation, but still correlated. We can see how well this tends to work for an inverse correlation, but it's not a strong inverse correlation because you can see quite a bit of activity where they want to pull together and remain in a normalized state or position. Even when you come back a little further in the chart, you see that normalization where both assets want to hug each other. So this is not really a good correlation in terms of what we want. That is the opposite or the divergence of both price actions. So let's keep going and see where we go. And you're going to find a lot of assets that really are correlated when you look at the market structure. And I'm going to put that into the terms of the context of a correlation where they typically tend to follow each other closely. Perhaps not at a 70 or 80%, but even at a 50% correlation, that could be a bad hedge. Okay, we see some more divergence, some more convergence. This one is definitely inversely correlated in a lot of contexts. There are a lot of crossovers, and that's good. Crossovers indicate that back and forth trending that we want to see. So this could be a good candidate for an inversely correlated pair. But the one thing to always pay attention to, Australian US dollar has a 2 pip spread. If you look at the spread here, 17 to 20 pips pretty much ruins the correlation between this asset versus Australian US dollar. So you have to look at all of the nuances carefully. The exotics are difficult to trade because the spread can ruin any advantage they might give you. And that is exactly the case here. The spread destroys the advantage. We're dealing with a 20 pip take profit, so having a 17 pip spread just absolutely decimates any profitability. And here you can see just how tightly correlated these two are. The euro-yen is remarkably correlated. Now we have a little bit more inverse correlation. The spread is still a little off, but it at least is reasonable. When looking at the two combinations, it's not as inversely correlated as I like, but it's a good candidate. Here is another exotic with obscene levels of spread. If it wasn't for the spread, it would be a good candidate. Always take into account your spread. That is critical. This looks like a good candidate. Looks like it's got plenty of crossovers. And by comparing the two charts like this, particularly with the strategy, we can see just how it would overlap with the possible implications of Australian US dollar having purchased positions as well. This particular one seems to hold into accumulation quite a bit. Now remember, we are looking at the blue line, which looks rather flat and stale compared to the red line, which is Australian dollar. So even though this is a good candidate, for my own personal tastes, I would pass on this one. I can't trade this one in the United States, but nonetheless, we can clearly see it's very correlated. Of course, Euro USD is also very correlated. Euro ZAR is inversely correlated, but the spread is obscenely high, comparatively speaking, to Australian USD. Okay, pound Australian dollar. This is an inverse correlation and a good candidate. In fact, it's actually a very good candidate. But I think we can do better. But you can see clearly the inverse correlation between the two pairs. This really is the kind of functionality you want, the kind of trading you want. So if you like this particular kind of pair, it's definitely something you should really put on your table, because it does do exactly what it's supposed to do. When the pound Australian dollar is going down, the Australian US dollar is going up, and vice versa. The correlation here is quite nice, about a 65 to 70% range. And that's good enough to really help hedge your risks. But let's keep going. Same thing with GBP Canadian. Here we see a little bit of a correlation, just not as sharp. Same thing, these are somewhat correlated. Also somewhat correlated. Inversely correlated, but not a strong inverse relationship. It's good to have on the table to look at, but I want something a little stronger against Australian US dollar. This is kind of an interesting one, but pay attention to your spread. If it wasn't for the spread, this could be a potential candidate. Here we see some more correlation. Of course, these are going to be correlated. The spread kills this one. This is a bit of a hit and miss. Remember, the New Zealand dollar is a bit of a flatliner. It really doesn't move very much, comparatively speaking, with its market. So it's good, but you want to be careful when dealing with it, because it's going to be a slow one that may stretch out significantly longer for holding positions. But I think we can do better. These are trending together. Also correlating. definitely correlating. In fact, this is a good example of just how close these two do correlate. This is kind of another mixed bag where the franc is a bit of a flat line, so it really doesn't do much in terms of a major shift, which means you're likely to hold a position for a longer period. If you're looking for trading, it's good to keep it on the table, but still keep looking. More correlation. And here we go. Perhaps the most inverse correlated we're going to find. Because we have USD on the left-hand side of the pair, whereas with the Australian US dollar, USD is on the right-hand side of the pair. That helps get the correlation or inverse correlation in a case that we want better suited. So this really is the kind of market we want. When the market goes one way, it goes the opposite way. When the market comes together, then they both come together. It's, again, not perfect, but the correlation here is about 85% inverse, meaning 85% of the time these markets move opposite of each other. That makes them the perfect hedge against each other. So for a risk mitigation approach, having that is absolutely critical. Again, it's not going to be perfect. You're not going to have a one-to-one relationship. But you can see that overall, the inverse relationship between these two pairs is quite strong. This is the kind of trade that makes a trade diversified. This is how you measure diversification. Not in the number of elements you trade or instruments, but rather how well these instruments react to each other. If the instruments go towards each other, meaning that when one drops in price, the other one drops in price, that's not diversification. You want the prices to go opposite to each other, so that when one drops in price, the other one is going to go up in price. That is diversification. Just because you trade 20 instruments doesn't do you any good if all 20 instruments tend to correlate against each other. That just means you have 20 times the risk and 20 times the likelihood of liquidation. So while diversification is good, diversification of similar assets is not. So you have to understand through this simple technique of actually seeing whether or not your assets are correlated or inversely correlated. Correlated assets are not diversified. They are simply magnifying the risk. Inversely correlated assets are magnified and are a good hedge against each other as long as you use the same trading strategy on both of them. Hopefully this video has explained that so that when you are trying to diversify your assets, you can get a view and an idea of how to trade one against the other. You want to trade them in such a way that you can get as close as possible to a 100% inverse correlation. That's never going to happen, but the closer you get, like in the 80s to the 90s, the better these assets are going to offset each other. If you found this video helpful, please give it a thumbs up. Those likes really do help in growing this channel. If you're not subscribed, please subscribe if you want to see more content like this. Leave me a comment. Let me know what you think. Have you been using this kind of a technique for diversification? Share your thoughts. Thank you for watching.